Hello everyone and welcome to this week's FX analysis. My name's Craig Erlam, Senior Market Analyst at OANDA. Thank you as ever for joining us. If you can hear me, please just let me know and then I can crack on with the webinar. As always, thank you, Stephen. As always, we will be starting with some fundamental analysis, looking at the week's key events, which may not be relevant to you or seem relevant to you if you're more of a technical trader. But even if you are a technical trader, I think it's always worth knowing what's happening on the week. For example, this week, if you are a sterling trader, you may not think of the fundamentals as being important, but come Wednesday, when they've got the inflation report hearing, it's worth knowing what's going on, because that's going to have a far bigger impact on what happens with your trades than any technical setup, because Mark Carney has such an influence over the markets. So being prepared for these things is important. So at least in my view. In terms of this week, though, there is going to be a major focus on the UK. There is plenty of other economic data. As you can see, we've already had things like the ZEW surveys from Germany and the Eurozone this morning. And we've got PMIs as well tomorrow. But if you look on Wednesday, there's two things which are really going to stand out. One is going to be this cluster of UK economic data, the inflation report hearing, and the speeches from Carney, Broadbent, Haldane, and Ten Renyo. This is all the same thing, I should point out. Carney, during these hearings in front of the Treasury Select Committee, is accompanied by his colleagues. So it's worth being aware of that, because, like I say, it's not just his views which are noteworthy. It is the views of his colleagues. This is a joint decision. Mark Carney doesn't have the rule over it all. What his colleagues thinks is clearly important. We've also got the jobs report on Wednesday as well. So this few hours that we have on Wednesday, I think we're going to see a lot of volatility in the pound, so it's worth being aware of that. In terms of what's important on the jobs report itself, you get a lot of data. You get earnings, claimant count, unemployment. At the same time, you get public sector net borrowing. The important piece of this does change from time to time. On this occasion, I really think it's going to be the earnings components which are going to be most important, because when you're looking at the Bank of England, you're seeing that they've already raised interest rates once. They're talking about raising interest rates again. The markets are already pricing in a rate hike for May and possibly even a second later this year. You're looking at the inflation components of this report, because ultimately, if they're raising rates, it's because they think the labour market is tight. So when you're looking at unemployment, unless that starts to spike higher, this isn't really a major concern for the Bank of England. The concern is, with unemployment at these levels, what impact is that going to have on people's earnings? What impact is that going to have on inflation? Now, of course, there's plenty of other factors at play here. The most obvious one being Brexit. Brexit's already had a big impact on inflation. We saw last week, again, we had a lot more economic data for the UK, that inflation remained at 3%. So it's this level that was making the Bank of England nervous, which is one of the reasons why they raised interest rates towards the back end of last year. The fact that it's remaining at these higher levels is going to continue to make people nervous. And if wages start to follow suit, that would suggest that we're going to see that second phase of inflationary pressures. There's probably a few reasons why wages are rising. I would imagine one of the key reasons why wages are picking up and likely to continue to pick up is the cost of living. If you are going into work and you know that it's coming up to the time when you're getting your pay review and your employer is saying we're going to raise your wages, and it isn't a freeze on, which of course there is in parts of the country, and your employer said to you we're going to raise your wages by 1% when you know full well that inflation is 3% or above, you know that your mortgage rate's gone up, you know that the cost of petrol, etc., is going up, then you're going to push for a bigger wage increase, and that is going to flow through on the aggregate sense through to these average earnings. Now, of course, this could be a temporary thing, because if inflation isn't expected to continue to keep rising in the same way in the longer term, then these could be one-off factors. But ultimately, this does mean that this initial plunge in the pound following the Brexit referendum could have more prolonged effects. And I think this is one of the reasons why the Bank of England is so intent on raising interest rates. As I've said before, my personal view remains unchanged, to be honest. I think this is still all currency related, and therefore, in my view, more consideration should be paid to the economy as well, because this is not a normal tightening cycle. Normally during a tightening cycle, you're getting higher inflation and you're getting higher earnings because demand is higher. You're seeing a tight labour market, people's wages are rising because there's competition for jobs, there's competition in terms of demand, and therefore prices rise and earnings rise with them. That's not what we're seeing here. That this is completely different. There's a number of economic headwinds. There's a lot of uncertainty linked to Brexit, and for that reason, the Bank of England needs to take this into consideration as well. Now, of course, I'm sure it is, but it's for this reason that I think the Bank of England may move more slowly than markets are pricing in. Now, you may remember that I've said previously on here, I don't think there's going to be a rate hike this year. It seems the Bank of England is intent on doing so. I still think the markets are a bit ahead of the game, and I still think the Bank of England may do so more slowly than the market's anticipating. I think the prospect of 2 rate hikes this year would seem a bit ludicrous, but then we'll have to wait and see how that pans out over the course of the year. But the most important thing is, from this jobs report perspective, unemployment isn't as important for me as that earnings figure. So this, I think, is going to be the thing that really triggers volatility in the pound. So that's what you should be keeping a close eye on. The fact that this follows a few hours later should ensure that sterling remains volatile throughout the day. If Bank of England policymakers continue to warn about higher interest rates, if they suggest things like the market is behind the curve, ahead of the curve, this is the type of language which people will be paying very close attention to. We saw the inflation and growth forecast previously, so this is priced in. The question is, we know the data, we've got the forecasts, what does this mean for policymakers themselves? So again, this will tend to last around an hour and a half, so this should ensure that sterling remains volatile. The day itself doesn't end there, though, because we get some data from the US, but more importantly, we get the FOMC minutes. These may be a little bit less eventful. The January meeting was Fed Chair Yellen's last as a member of the committee. She will be replaced this month by Jerome Powell, so the next meeting, which will include a press conference, I believe, will be headed by Jerome Powell. There are other key positions which will be filled over the course of this year, which is going to have a big influence on the Fed outlook as well. We could see from the last Fed statement that the central bank is a bit more hawkish, that it's a bit more optimistic, and this is something which we will be looking for in the minutes. But I don't expect the minutes to contain anything that is more significant or much more significant than the statement. I may be wrong, but I think to lay something down like this prior to Jerome Powell's first meeting, I think the meeting headed by Jerome Powell will be a much better time for the Fed to strongly indicate a more hawkish turn, even while taking into consideration the tax reform at the end of 2017, the impact we've already seen it have on earnings and earnings prospects in the US. I think they may save that for the Jerome Powell meeting. I may be wrong, but again, I'm sure there'll be plenty of volatility just based on the expectation around the release of these minutes, which come in the evening in the UK and later on in the afternoon in the US. In terms of the rest of the week, there are some notable data points. So things like the UK GDP, again, keeping the UK in focus. Central bankers will be speaking throughout the day. You can see William Dudley here, Kashkari here, etc. We've got inflation data from the Eurozone on Friday, and GDP early in the morning from Germany, and Bank of Canada inflation as well as a couple more speeches. So there's plenty to keep an eye out for this week, but really I think the key focus will be Wednesday, that UK jobs report, the inflation report hearing, and the Fed minutes. Now, of course, the week's got off to a bit of a slow start because we had the bank holiday in the US and Canada on Monday, so we're just seeing a return for the US today. News flow has been a little bit quieter. The markets are settling down. We have seen a bit of a rebound, for example, in equity markets. They've halved their losses, which we saw over the past, which started about 2 weeks ago. 2 weeks ago on Monday evening in the UK. We do seem to be settling down a little bit. Volatility does seem to be coming back to normal, although it still remains heightened. I still think there's going to be a vulnerability in the markets to keep an eye out for. But ultimately, I think the data, the inflation report, the minutes is going to be the key focal point this week. And then, of course, if markets do start to get quite volatile again, then that will take the reins. But there's no other major events of note. So with that, we will move on to the charts themselves. We'll start with euro dollar, and you can see that I've added a fib on here, and the reason why, and you may have seen the piece that I wrote yesterday evening on euro dollar. We have made a new high recently, but the thing, when I'm looking at this, I'm not feeling overly bullish. Now, when I say that, I do not mean the long term. I think there's clearly the prospect for some more gains to come in euro dollar in the long term. I think the US central bank is very much well underway in its tightening cycle. The European Central Bank is well behind, so the prospect for tightening is clearly far greater from the ECB. And I think a lot of what the US Federal Reserve wants to do is priced in. But when we look at this chart in the near term, we've had a nice strong rally off the lows on the 7th of November. This itself came off a brief correction when we were above 120. We came back to around the kind of 115s. It looked at times like it was going to be steeper correction, but we didn't quite see it. This bullish appetite for this pair, broadly driven, I think, by negative sentiment towards the US dollar, just drove this back above 120. We've come back towards the kind of 125s, 126s. But what's interesting is we made the new high back on the 25th of January. We saw a bit of consolidation. We failed to make a new high at the start of Feb. So this was giving us potential signal that the rally was running out of a bit of steam. You could even look at this as a bit of a double top with the neckline here around the kind of 123.30s. We broke through that, so that could have prompted a bit more of a correction. But once again, as we saw back here, the correction wasn't as necessarily as steep as you would have typically expected or typically associate with a double top, purely from textbook speaking. And we started to rally higher. Again, that negativity towards the dollar really is driving things quite a lot at the minute. And then we rose to new highs. Now, what we failed to do here is make new highs, which is what we did a few days ago. The difference is, when we were moving towards these new highs here, the momentum looked as though, if you look at, for example, the MACD moving averages, was still possibly with the rally. Even though you were seeing warning signs, for example, in the MACD histogram, even potentially as well in the stochastic, it looked as though the momentum was growing with that rally, but we failed and we came back. Now we've made the new high compared to this high, but it's clear that momentum is starting to lack. And you can see it in the stochastic, the MACD moving averages, and the MACD histogram. Now, this in itself is not a sell signal. It's not a bearish signal per se. I refer to this as a red flag. This is a sign that momentum is starting to fall out the move, which is called negative divergence, which can signal a potential correction or reversal. Again, if we do see a move back towards these kind of levels, you could be looking at this as a neckline around the 122s with a potential double top forming here around the 125.40s, 125.30s, 125.50s. And if we see a break below this neckline, then that may signal a move back towards these kind of 119 kind of areas, which is why I've added the fib, because you look at that coincides quite nicely with the 61.8 fib. There is the potential, given what we've seen back here and again back here, that dollar bearishness may just take over. So even if we do see a break at that level, it may not complete based on what we've seen previously. But I think the dollar's due a correction. I think the sell-off is potentially overdone. I think the Federal Reserve Central Bank is very active. I think tax reform puts more pressure on the Federal Reserve to raise interest rates. And I think an element of this is being overlooked right now. And I think a correction in the dollar wouldn't be the end of the world. And the fact that we're losing steam in this upside, given we've made huge gains already, I think the timing of this would be relatively apt. So that's what I'm keeping an eye on quite at this moment in time with euro dollar. Pound against the dollar, we're seeing a similar pattern. We didn't make a new high, but we have come up towards that 61.8 fib around 141.25 and run into a bit of resistance. Now, I've added this fib here, this near-term fib, because if we do see a rotation lower, this could be an early warning sign of a bit of a correction, a reversal. I've got the longer-term fib on here because ultimately we are in an uptrend. I think what's interesting with this pair in particular is that while the news flow for the UK is more positive, and we're looking at the central bank and markets are pricing in or possibly 2 rate hikes this year, we can't underestimate what impact political uncertainty can have, especially with regards to Brexit. And the UK and the EU are in negotiations at the moment to determine the transition deal, which they wanted to have wrapped up by March. The closer that deadline becomes, if that deal's not wrapped up, that could weigh on the pound, and that could help to aid something of a correction in this pair. Now, we've seen a rotation off here. This isn't obviously necessarily a bearish signal at this moment in time. It could quite easily just then pop higher. But again, I'm just keeping an eye on a couple of key levels, and one of them is that kind of 142.30 level. If we break below the 137.65s, then that could signal a sharper move to the downside. That would bring interest into this kind of 50.61.8 fib zone, prior resistance, retracement level, marking of a correction from the lows here on the from the 6th of October through to the highs of the 25th of January. But again, I think the transition negotiations could have a big impact on this. So I'll be again keeping a very close eye on this pair. I'm not going to spend too long on Euro sterling because nothing's changed here since the last video. Very choppy, very range bound. Again, we've tested resistance around these kind of 89s just above, and we failed, and we've headed lower again. Support really. Interestingly, though, we are seeing higher lows. That is a particularly interesting point for me. Let me just mark that on here. So you can see these lower lows which we've had just here. We've had two higher lows. So I'll be keeping a close eye on these kind of 87, 70s, because if we rotate higher off here, that could suggest that there is a slight momentum with the bulls, even if we are quite choppy and quite range bound. But ultimately, you can see this series of, more broadly speaking, you can see basically from back here, we've got this kind of region, this congested area where we keep seeing buying pressure come back in, and in the near term you can see this resistance. The reason for this, quite simply for me, is that the dollar is really driving a lot of what we're seeing in FX markets right now. We are seeing more bullish sentiment towards the euro, but we're also seeing more bullish sentiment towards sterling. And when you pair them against each other, that just makes for choppy markets. It's a battle of two of the stronger currencies right now, at a time when ultimately the dollar is a major driver in FX markets. So we look at the Australian dollar versus the US dollar here. And you can see that previously, over the last couple of weeks, and I think since the last webinar, we came back to this level, and we highlighted this level in the previous webinar because this is where we've got the congestion of the 4 moving averages, which I use on my chart, the 55, 89, 200 and 233 moving averages. These come in at around the 77 to 78 level. And we've rotated high, but again, we've run into resistance around that 61.8 fib, just shy of 80, which is a notable psychological level, although we did chop through here a few times here. Again, I'm keeping a close eye on it, not because I think this is therefore a sell signal or a bearish signal. I'm keeping a close eye on it because if we are going to rotate lower and we are going to see a correction in the dollar, then that would be a notable level for it to potentially do so. So if we continue to see this trend lower, maybe break below these support through these moving averages, potentially this is signaling a move back towards these previous lows, and ultimately then when we're looking in the longer term, we are looking at a kind of lower end of the range here and an upper end of the range here. again, a break below these previous lows, as you'll see later in dollar yen, would be quite a bearish signal, but I think we're still away from that yet. Dollar CAD is much of the same. We have seen a nice correction here back to 61.8 fib. This is a level which you've highlighted previously. Again, this pair has looked quite bearish. We had the move, the initial sell-off back here. We had the correction back to here, which I think was a 50 fib of that move here. We had this nice triple top form before we broke lower. That was completed. We even broke to new lower lows, looking as if we could be headed back there, but we've had a nice correction. We've come into the 61.8 fib, which is prior support from that triple top, and we've rotated lower. We're having another stab to the upside. I'm still leaning more towards bearish here than bullish. I know I'm talking about the potential for a dollar rebound, but looking at this, if we see a break through those highs, then I'll become more bullish the dollar, and then all of a sudden these levels start to look quite interesting around the 29s, even 28s with the moving averages coming into play on the daily side here, which proved to be a bit of a resistance back at this point here as well. But we have had a lower high here, so until we see this series of this lower high broken, so if we break above the 2650s and then through the 2685s, then that could start to look bullish into 28s and then into 29s potentially. A rotation lower here, though, would then bring this 2450s back into play and potentially signal a move back here. Again, this could heavily depend, as it has, for example, particularly through this phase, on whether we are going to see that continued sell-off in the dollar. I'm still skeptical, and I would very much like to see a breakthrough these 2685, say 27s, because that would signal to me that we're potentially seeing a move back up here and potentially further, depending on how big a correction we can see. Of course, like I say, that the 28s could be a notable level along the way. Sterling CAD is looking quite interesting right now. We've seen some consolidation in the pair, but you can see clear resistance here around the kind of 76.50s. We've run into resistance here on about 3 or 4 occasions, but during that period we have had a gradual series of higher lows. So I'm very intrigued to see if we can break above here, because if we can break above here, that would be a nice little bullish signal, potentially signaling a move of around, say, 300 plus pips to the upside based on the size of that like rising triangle, taking the opening, projecting higher. Again, this is just textbook stuff. This isn't precise. This isn't advice. This is just possible price projections, as I always refer to. And if we did see that, then a nice move 350 pips higher would take us back towards those kind of 180s, at which point, just to zoom right out, my laptop's decided to be a little bit slow, so apologies for this, just waiting for it to catch up. The point is, it'll take you back towards the 180s while it catches up, which is a nice big psychological level, and if I'm not mistaken, it'll also represent the resistance level from this peak here back in May of 2017. And it would be a bullish signal, which is in keeping with the higher lows that we are seeing here. So the trend is looking bullish. That's not to say that we'll definitely see a break to the upside, and as always, we typically wait for confirmation of these things rather than just make assumptions. But at the moment, this is a bullish signal. But a break below this rising trend line could signal a break of that. 174 would become notable at this point, and then ultimately here around the 173s would. But at the moment, I think this is looking a little bit bullish. So the high actually previously back in May was around the 178.50s, 179s, but you can see back here, previously when we were trading around these levels, around these kind of 180s, 181s, was a very key area of support prior to us breaking down here on Brexit Day. So a break through this rising triangle would potentially signal a move back towards these kind of pre-Brexit levels, similar to what we're seeing in the against the US dollar as well. Seems one by one we are marking the move back into pre-Brexit, although against certain currencies like the euro, we still remain a fair whack away from here. Let's move on. Kiwi dollar. Interesting again that we are seeing it back around these 174.40s. Once again, we've run into resistance pretty much right at the peak of this high here. 3 or 4 times we've hit these levels. We did see correction back towards the 71.75s before having another burst higher. The question for me now is, are we going to see a higher low made, which would suggest that this is bullish just like that sterling CAD move, or are we going to see a move back to here, which would mark almost a textbook perfect double top and could potentially be a bearish signal if we see a break below here. I'll be keeping a close eye on these fibs. That 73 was a notable area here, falls between the 61.8 and the 50 fib, making this a notable zone, but a break below the 61.8 fib would put a lot of focus on that 71.75 for a potentially very bearish move shortly after that. We'll wrap things up with the yen pairs. We finally saw that break below the kind of 108 zone, which had long been an area of support during this period for this pair. We've talked about it for quite a while, 108, 114.50 being notable areas, but we had that little blip to the downside here. But that was a false breakout. So we finally broke below the 108s, and we saw how sharp the sell-off was from there on in, because clearly a lot of stops being triggered and a lot of people capitalizing on that long-term breakout. We came back towards those kind of 105.50s, and now we're seeing a bit of a correction. Notable levels on the way back up typically is that prior level of support here around the 107.30s. I'd like to see a move back towards these kind of 108s. You've got the 50 fib there, and you've got that long-term support, which could provide significant resistance on the way up. I think a move back towards here, and I think this could be a particularly interesting test for the pair. Sterling yen as well, we have seen a bearish break as well. So this is going to be partially yen driven. Of course, the last 2 weeks has prompted a lot of risk aversion. Risk aversion tends to favor your safe havens, the yen being one of them. In this case, with the pound, we broke through the this previous low here. You could even call this potentially a bit of a double top. We broke through the 55.89 moving average, which has long been support for this pair. We broke through the Ichimoku cloud, which is extremely significant for yen pairs, and now we're seeing a bit of a correction. We've got the 200 and 233-day simple moving average potentially providing some support below as well, as it has on a number of occasions here and here, and it provided resistance before breaking higher here as well. So a break below that moving average would also be quite significant, almost confirming the break of the cloud as well. If we do see a correction again, I'd like to see a correction back in towards these kind of levels, the moving averages, 38.2, the 50 fib, the cloud, all of which provided support on the way up. A nice rotation off this would be confirmation of that initial break and be a very bearish signal for this pair. So I'd like to see a move up there if we possibly can, although in the shorter term you're looking at prior support levels as possible resistance here. So you're looking at these kind of 150s, of course, a notable level. You can see 1, 2, 3 touches there, rotating high on the way up. So that could be a possible rotation point lower. But ultimately, I'd like to see 151, 152 being tested. Euro yen, again, we've also seen a move below the Ichimoku cloud and the moving averages, both of which provided support for the pair on the way up. At times, it looked as though we were going to see a break higher, but this risk aversion again dragged it lower. We found support again from this support here. We've a long-term support, so it's not surprising that we found support again twice. We're not seeing much appetite for upside corrections here, which is quite interesting. We're just seeing consolidation, really. I think a break below here could be quite significant. I think 130 would become very significant from there. You can see that this is roughly around price support, but also where we've got the 200 and 233-day simple moving averages forming there as well. I am... Again, I always like to see a correction, and back into this 38.250 fib would be lovely. You've got the cloud, you've got the moving averages, etc. I'd love to see that, but there doesn't seem to be much upside appetite here, which is particularly interesting given how strong the euro is being. Potentially a near-term bearish sign for the single currency there. Well, that's all for today. Barring that little mishap, I hope you all found that useful, and you'll join us again, I think, in 2 weeks for the next webinar. But apart from that, thank you very much as ever for joining us, and I will catch you all again very soon. Thank you very much.